The hierarchy of capital: why productive store of value assets dominate wealth. Humanity's accumulated wealth follows a clear observable hierarchy. While money traditionally serves three functions: medium of exchange, unit of account, and store of value, the store of value layer overwhelmingly dominates total asset valuation. This is not primarily because people like saving, but because store of value assets accumulate across generations with low velocity, while medium of exchange assets circulate rapidly to facilitate transactions. Economies need only enough transactional balances to clear daily commerce. They do not require vast stockpiles. In contrast, store of value assets stack relentlessly, year after year, generation after generation, driving their market values to tower over other categories. Global data consistently shows real assets, particularly real estate and productive enterprises, comprising the bulk of net worth. This dominance reflects a deeper truth. Once basic exchange and measurement are solved, capital naturally migrates toward durable long-term preservation. Yet within the store of value category itself exists an even more important internal hierarchy, one that explains why certain assets consistently outperform and attract the majority of global wealth. Section 1. The store of value hierarchy, from pure preservation to productive yield. Level 1. Pure preservation, simplicity first. These assets prioritize reliability, portability, scarcity, and minimal operational burden. Classic examples include gold, silver, Bitcoin, often described as digital gold, cash, short-term treasuries, and undeveloped land. They excel as crisis hedges and insurance against inflation or debasement. Their strength lies in simplicity. They require little management and carry low counterparty or operational risk. However, they produce nothing. Their value depends entirely on future buyers being willing to pay more or accept them in trade. They are shiny rocks, durable but sterile. Level 2. Preservation plus contractual yield. Here capital begins to seek return. Bonds, lending arrangements, credit instruments, and certain inside money claims, such as bank deposits or treasury-backed stablecoins, offer yield through promises and contracts. This layer introduces counterparty risk. The yield depends on the borrower's performance. While still rooted in store of value foundations, these assets start bridging preservation with income. Level 3. Preservation plus endogenous productive yield, the apex. This is the sweet spot where capital naturally concentrates. These are the orange trees, assets that generate real ongoing output without needing to be fully lent out or risked. Examples include operating businesses and equities through earnings growth and dividends, farmland and timberland through crop or harvest income, income-producing real estate, including residential rentals, commercial properties, and warehouses, infrastructure, including toll roads, pipelines, data centers, and utilities. You invest once and receive tangible production indefinitely: rent, crops, profits, or usage fees. These assets combine durability with compounding. They hedge inflation through both price appreciation and rising output. Warren Buffett captures this perfectly when he contrasts sterile assets like gold with productive ones like farms or apartment buildings. The latter deliver real goods and services year after year. The orange tree does not merely hold value, it multiplies it through economic contribution. This hierarchy is not absolute. Productive assets trade simplicity for yield. They introduce management risk, operational complexity, political exposure, and illiquidity. That is why pure store of value assets, such as gold, Bitcoin, and treasuries, persist. They serve as low-maintenance reserves and safe havens. The hierarchy reflects a rational trade-off, not a universal ranking. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 2. Deferred payment as a derivative function. Traditional textbooks sometimes list standard of deferred payment as a fourth function of money, enabling credit and long-term contracts. This is pedagogical, but imprecise. Deferred payment is not independent. It is a derivative that emerges from strong store of value combined with reliable unit of account. Lenders demand confidence that the principal will retain purchasing power over time, the store of value function, and that the obligation can be clearly measured and accounted for, the unit of account function. Without these, credit markets collapse as seen in hyperinflationary episodes. The yield upgrade is therefore a natural extension. Once preservation is solved, capital seeks to earn returns on that preserved value. Section 3. Inside money versus outside money in the hierarchy. This framework also illuminates the classic distinction between outside money and inside money. Outside money. Outside money, such as base money, physical cash, central bank reserves, and historical commodity money like gold coins, sits primarily at level 1. It is exogenous, carries no private sector liability, and optimizes for pure preservation. It forms the stable bedrock. Inside money, including bank deposits, credit creation, and lending, operates in levels 2 and 3. Banks and intermediaries take preserved capital and channel it toward productive uses, lending to businesses, homeowners, and farmers. This mobilizes savings into real economic output, creating yield at scale. However, it introduces leverage, maturity transformation, and systemic fragility. Real estate perfectly illustrates the interplay. It functions as a consumption good, your home, a productive asset, rentals and commercial property, critical collateral that fuels inside money expansion. A large portion of its valuation derives from its credit creation capacity, which itself rests on its perceived store of value strength. Section 4. Why this matters. The hierarchy reveals a consistent pattern across history. Societies first secure reliable store of value at level 1. Once preservation is achieved, capital predictably climbs toward productive forms at levels 2 and 3 because compounding real returns outpace pure scarcity over long horizons. This explains why farmland, businesses, rental properties, and infrastructure dominate global wealth despite the enduring appeal of gold and Bitcoin. Productive store of value assets do not merely store wealth, they actively participate in and contribute to economic growth. They solve the opportunity cost of holding sterile assets. The orange tree planted today continues bearing fruit for decades. The gold bar does not. This framework is both descriptive and prescriptive. It clarifies why sophisticated investors, Buffett included, gravitate toward productive real assets. It explains the persistent dominance of real estate and enterprise in national balance sheets. And it offers a coherent lens for evaluating new assets, including tokenized real-world assets, yield-bearing cryptocurrencies, or infrastructure projects in the digital age. Section 5. Conclusion. In the end, capital behaves with remarkable consistency. It first seeks safety, then relentlessly pursues productivity. The shiny rock has its place, especially in uncertainty, but over time, the orange tree wins. Understanding this hierarchy helps explain the past, navigate the present, and anticipate where wealth will concentrate in the future.